Hey guys, hope you guys are doing well. We are quickly going to discuss impulse swings, liquidity, and market protection. So we're currently on the 15-minute on EU. And just a little tip for you guys when it comes to specific protections. This is where I believe that the market is algorithmically delivered. There's a computer or an AI or whatever the case might be that gives us the price action. This is done by the central banks because they control the currencies, and the banks are the participants or big fish in the market. But these candles are given to us by an AI which is controlled by the central banks. It's the only thing that makes sense to me as my personal opinion. I'm not saying it's the gospel. It's all I'm saying is, and the reason why I'm saying that is there are clues in the market where there's consistent situations happening at a very specific time. So let's take, for instance, let's go to New York. It's UTC -4. Let's go to midnight, right? Midnight New York time, right here. Okay, we're gonna do it again. Midnight, right here. Midnight New York time. Midnight New York time. Let's just take these three examples right here. So at midnight, you always see some sort of specific impulse or movement, and then there is a counterparty. So what happens is we can see there's a downtrend. Market is getting ready for trapping sellers into the market. So we have the sells, everybody's getting in because what an impulsive movement. Let's get in for the early sells, and then it turns around and takes your stop loss. This is a perfect example of liquidity as well. So you are thinking, flip, I missed the move, let me just impulsively enter, and sorry about that, I'll put my stop loss at these highs, for example, right? And all I'm targeting is wherever I think price is going to go. Let's say it's going to go there. What happens? Market turns around, hunts these stop losses in this candle, and then goes even further and hunts the rest. That is liquidity. Liquidity is stop losses, either on old highs when you're selling down or old lows when selling up. So I'll show you another example right here. So you entered here somewhere. Let's say you entered here. Let's put in a buy. Let's put it in on that little candle right there, just to make sense of the example. You're putting your stop loss here at the bottom, and you are targeting these major highs here at the back. This is an extreme high. Remember, look how far price has gone from that high. So it's a very strong high right there, because it's protected by these levels right here, these resistance levels. So what happens? You are looking for a buy, and cool, price has gone into your favor, and then all of a sudden it switches on you. And once it's switched on you, you got taken out. Your liquidity has now been swept right there. Let's say you put your stop loss right there. You've been taken out. Or even there, you've been taken out if you put your stop loss lower. Because right here, right there, right there, right there, you can see how the stop losses have been hunted. And always notice one specific thing. When there are stop loss raids, when they are hunting your stop loss, when they are trying to get that liquidity, remember, these are all liquidity, right? That's why I put the $sign there, just for myself to make sense that is a liquidity right there. Look at when it's hunting for stop losses, how price speeds up. Price wants those stop losses. Took all the stop losses, started slowing down, and reversed the other way. Again, stop losses speeds up. Stop losses speeds up. Big candles, because of stop losses. Now we have sellers. Now they are going to take the selling stop losses because everybody's selling the market, because look at how bearish it is, not understanding that the market has flipped. Why has it flipped? Because look at this rejection candle. Also look at how big the buys are getting. So the buy candles and the buyers are getting far stronger than the sellers. So now they're targeting liquidity on this side, targeting liquidity on this side, targeting liquidity, yeah, and yeah. All these liquidity levels have now been taken in a lot less time than it took to generate them. So that's what the market wants. The market is always looking for counterparty participants. So counterparty, if the market's going down, they are looking for buyers. If the market is going up, they're looking for sellers because they want that liquidity to continue their moves up. So the market is going up, they're looking for sellers. So here's the sellers, all these sellers. So they take it, retracts, moves again, eats all that liquidity, retracts or protracts, moves and takes all that liquidity. Okay, that's liquidity sorted. Let's go to the midnight protraction. So on New York time midnight, there's always a protraction. Remember, we on UCT4. So this is New York time. It's midnight. It's 6 a.m. outside. Let's just go to Johannesburg. It's 6 a.m. So what happens? Market is making you think, listen, we haven't broken these highs at all, so we are going to sell. When New York midnight happens and you see a selling or buying, prepare for entries to the opposite. So the opposite is, okay, market is selling now. New York open is a bearish candle, or New York midnight is a bearish candle. It's making us think market wants to go down, but we understand that the market has already turned right here. We can see it has turned. Why has it turned? It's taken new highs. It's made new highs, right? It still needs to take this, but the consolidation has been moving up. So we've made new highs, but we haven't broken it. The theory is only enter buys if New York open is selling. If New York midnight is selling, you put in buys. There's my theory. There's the proof of it. And let's go find another one. New York open is a buy, prepare for sells. New York midnight is a buy, prepare for sells. Is another example. New York open is a New York midnight. Sorry, I keep making this mistake. New York midnight is a sell, prepare for buys. There's your buy. There's your buy. Let's go look at other examples. Let's find midnight again. Oh wait, it's 6 a.m. Sorry, because we're in Johannesburg time. It's buying, prepare for sells. 6 a.m. again. It's a selling candle, prepare for buys. But in this situation, you'd be a little bit more careful because it's not giving you a clear, it's more of a doji than anything else. It's a small indecision candle, and you don't have a clear answer. So once you see the market shifting, something like this, where this candle is giving you the clue that it's turning around, you enter a buy. Remember, you also need to understand what the candles are telling you. There's hints in price. Price will always give you clues of what's going to happen next. Again, one more example. Let's find 6 a.m. There. Okay, market has been selling. It then turns up and it goes around. This is what we call protractions, because of New York midnight and the manipulation that wrong tool, and the manipulation that they. What am I doing? I'm so confused right now. Oh yeah, I'm still on Johannesburg. Okay, so there, 6 a.m. down candle, prepare for buys. So always, if you are able to trade 6 a.m. till 9 a.m., Just be aware of that. Be aware of that happening, and that it will take part. You see your sell candle. Now you wait and you be patient and you prepare for a buy candle. You could enter on this buy candle. You could put your sells at least just here. Just put it there, because you are only using this theory for small scalp. You're looking for small profits. You can trade it until your profits turn around or your trade turns around. This is a small trade, small stop loss. It's a 3-pip stop loss. You're making 15 points. That's it. It's all you need. 15 pips. It's a small trade. It's a W for the morning. You move on. So I hope this helps. I hope you guys understand. What are impulse price swings? Let's just go through that again. So switch. Impulse price swings. Price swing, impulse. Swing, impulse. Swing, impulse. Swing, impulse. So swing, impulse. Swing, impulse, or it could be the vice versa. Swing, impulse. Swing, so market goes swing, impulse, swing, impulse. Those will happen. Then these are called protractions as well. It's just a fancy word, but let's use protractions for the midnight thing. Then we've spoken about liquidity. Be aware that liquidity can be used either for targets or entries. So don't put your stop loss at the obvious points that are going to get taken. I hope that helps. And then there is the New York midnight, hour 6 a.m. time. A little tip. And yeah, there's your market swings, liquidity, and protractions. Hope you guys enjoyed the video. Hope it helped. Maybe this will aid you in the future, and you can get a little scalp off and just get in and out of the market, make a little bit of money on the side, and leave for the morning. All right. Have a lovely day, guys. Cheers.